Did you know CPAs work around the clock on taxes, audits? Yes, it's quite a shock. But business owners, they've got a dream. More tax saving strategy, that's what they need. Welcome to Proactive Tax Strategies. And we're here to take away high tax fears. We got secrets, magic in our hands. Tune in as we travel.
Welcome, everyone, to another episode of Proactive Tax Strategies. I'm Patrice Sikora. Our host, Ken New, owner of Pinnacle Financial Wealth Management and team-based model consultant, enjoys diving deep into the world of tax strategies. And today we have a special guest back on the show with us, Darren Sugiyama, founder of LionSmart Capital. Mr. Sugiyama started his own employee benefits firm in 2003 called Apex, and later founded LionSmart Capital in 2016. It is now one of the most dominant premium financing intermediary firms in the life insurance industry. Darren is also an internationally acclaimed 11-time author, business coach, and mentor. Darren Sugiyama is back for a third episode of Proactive Tax Strategies to discuss the IRA Bailout plan. So, without further ado, let me hand it over to you, Ken.
Thank you, Patrice. So we're going to talk about the IRA bailout plan today. So, Darren, what is a IRA bailout plan, and who do you think can benefit from this type of strategy?
Yes, it's basically a strategy for wealthy individuals that have large IRAs over $1 million. And these folks have built up enough net worth outside of their IRA where they're probably not going to need to use it for their own personal retirement. Their kids are going to inherit those funds. When their kids inherit those funds are going to be double taxed, which we'll get into on today's podcast. But that double taxation really erodes the value over time. Let's say you have a client that's worth $20 million in net worth. Again, they have a substantial IRA. In the state of California, where I live, they're going to lose a little over 70% of that IRA value when their kids inherit that asset. And even for people that live, say, in the state of Florida or Texas, where there is no state income tax, the total tax erosion on these IRAs can be as much as 62.20%. So we have a solution for that, which is the IRA bailout plan.
Yeah, now that'll get your attention. 70% loss in the state of California. And so that double taxation is huge. But let's get to the basics here. Let's talk exactly what is an IRA.
Yeah, an IRA is an individual retirement account. And most wealthy individuals that have large IRA, these are folks that had some sort of pre-tax retirement account, like a 401k, for example. And that 401k was funded with pre-tax dollars. And when they were done working for their employer, typically they would roll those 401k funds into an IRA, which has the same tax treatment as a 401k, tax-deferred growth, but 100% taxable on the way out. Now, the benefit, or I should say the perceived benefit, is that by contributing these pre-tax dollars, you have the benefit of compound interest working in your favor, as opposed to contributing the smaller after-tax equivalent.
Okay, so the devil's in the details then. So isn't that actually true?
In theory, when I say in theory, I mean, it does make sense on the surface, but it always cracks me up when I hear someone say, oh, my IRA is worth X dollars, $1 million, whatever, because that's not technically all their money, right? A good chunk of that belongs to Uncle Sam. And if they're wealthy enough where their net worth is above the estate tax threshold, not only is that IRA going to be subject to income taxes, but it's also subject to estate taxes, which is currently 40%.
Yeah, so there's where the conundrum is. So for people in really high tax brackets, or high tax brackets in general, it sounds like this whole idea of contribute to pre-tax dollars theory might not always ring true. Is that a fair statement?
That's why a lot of wealthy people are encouraged to roll their traditional IRA funds into a Roth IRA, better known as a Roth conversion.
Yeah. So let's get into the Roth conversion conversation then. So what exactly is a Roth conversion, and does it make sense for someone who has a large traditional IRA?
Well, it depends on the client. All right. Like, for example, if they are not going to use their IRA funds for their own retirement, the downside of leaving the funds in the traditional IRA is that they will be subject to RMDs, right? The required minimum distributions.
Yep.
Uncle Sam makes you draw down from your IRA starting at age 72. Fast forward till the year 2032, that age gets pushed back to age 75. But again, for people that don't need these distributions for their own retirement, that's part of where the Roth conversion comes in. If they convert to a Roth, they have to pay the income taxes on the full amount that they convert immediately. However, the nice thing is that Roth IRAs are not subject to RMDs. So the client can just let those funds grow tax-free from that point moving forward because they already paid the income tax on those amounts when they converted. And again, they don't have to take the RMDs, which ultimately can increase the total amount that their kids inherit.
Yeah. All right, then. So now, how are we going to know which way to go here? The traditional IRA, let it stay tax deferred, or switch it over to the Roth conversion? How do you make sense of that?
That's basically where our firm comes in. We do the analytics from a mathematical perspective. And in most cases, for high income and high net worth individuals, the Roth conversion makes more sense than just leaving the funds in a traditional IRA.
Yeah, I buy that. So I understand the whole idea that it might make sense to pay taxes now on the Roth conversion, so you don't have the RMDs. But isn't the Roth still subject to the estate tax, the 40% estate tax?
It is. Yeah. That's really the problem, which is where our IRA bailout plan comes in. In this scenario, our clients will roll their IRA funds into a profit sharing plan, which then buys a life insurance policy inside the plan.
Interesting. Okay. All right then. So how is the profit sharing plan established? And does a client need to have an active income producing company to sponsor the profit sharing plan?
Yeah, if they have an existing company, they could certainly use that entity to be the plan sponsor. In other words, to sponsor the profit sharing plan. However, for liability purposes, it's typically better to set up a new special purpose LLC, of which the married couple are the only members of the LLC. They're also the only W-2 employees of the LLC. That way, they don't have to include any of their other employees in their primary business in that profit sharing plan. So they could do it either way.
Okay. All right then. But what about the affiliated services, the discrimination testing? And aren't they required to offer a profit sharing plan to their employees in their other company?
That's a great question. If the new LLC provided similar business services or related business services to their current company, that would not pass the smell test, right?
Mhm.
However, if the new business entity, and in this case, if we use an LLC, had a legitimate business purpose that was completely unrelated to any other existing business, then it's really a non-issue. In most cases, the business purpose of the newly formed LLC will be to manage the family's wealth, kind of like a family office. And the married couple would be the only members of the LLC, and we would put them on a legitimate W-2 employee payroll for a nominal amount. And then the business would be the plan sponsor of the profit sharing plan.
Okay, sounds like we got some details there, some things to pay attention to. Now, once the new LLC is set up and the payroll's established, you then set up the profit sharing plan. Is that correct?
Correct. Yep. We have an attorney that drafts the plan document, which usually costs around $1,600 or so. And then a TPA or a third party administrator administrates the profit sharing plan to keep it in compliance, which is typically about $2,500 a year to administrate a nominal amount. And then the client rolls over their IRA funds into their individualized profit sharing plan allocations.
Okay, so it seems like we're getting the structure together here, or we're moving down this strategy path here. Let's back up for a second. What are the tax consequences at this point?
Yeah, at this point, nothing. It's kind of similar to rolling a 401k into an IRA, right? We're just rolling the IRA funds into the client's profit sharing plan, one qualified fund into another qualified fund. So no taxes due at that juncture.
All right, so that makes sense so far. So when does the life insurance component enter the picture here?
Once the profit sharing plan is established and funded, the client will then purchase a life insurance policy inside the profit sharing plan using those pre-tax dollars. As an example, let's say the IRA value was $4 million, as an example. we would use that $4 million to fund 4 years of $1 million annual premiums into the life insurance policy. And then after 4 years, the client would use an ILIT, an irrevocable life insurance trust, to buy the policy out of the profit sharing plan. And now that policy is owned outside the client's taxable estate.
All right. And so, what is the purpose of buying the policy out of the profit sharing plan?
Yeah, I mean, that's the nice thing about the ILIT is that now the policy sits outside the client's taxable estate. There's kind of the moving parts of it. The client gifts some of the funds to the ILIT, which would then use up some of their unified credits under their gifting exemption. And then the ILIT would then buy the policy. So now the policy is owned by the ILIT outside the taxable estate, and the purchase amount goes right into their profit sharing plan. But a big benefit of this transaction is that the policy's true value is less than the premiums paid. So the buyout is at a pretty substantial, deep discount.
Okay, well, that's interesting. So, when you talk about this deep discount, so what exactly does that mean when you say discount?
Yeah, the value of a life insurance policy can be determined really at any time. And there's more than one way to determine the current value. One way is to have a third-party valuation firm estimate the fair market value, which is somewhat subjective and debatable. So we typically don't use that method. Another way to do it is what they call the ITR, the Interpolated Terminal Reserve, which is determined by the carrier. However, this method of evaluation is kind of under some scrutiny, so we don't use that one either. The third way to do it is known as the PERC value, PERC, which is a calculation of the premiums that are paid plus the earnings on the cash value minus any reasonable charges. To be conservative at our firm, we use the IRS safe harbor valuation under Revenue Procedure 2020-25. This is an indisputable valuation and really the most conservative way to do it. You see, because the thing to understand about life insurance policies is that the majority of the charges are really in the first several years of the policy. If you bought, say, a $20 million life insurance policy and you pay $1 million of annual premium for 4 years, the cash value, depending on the policy design, might only be 40 to 80% of the premiums paid. So we're talking about getting somewhere between a 20 to 60% discount, again, depending on the policy design. And that discount is hugely advantageous to the client.
Yeah. So that's a lot of technicalities there. A couple of them you don't use, and the one you do use is the most conservative, if I'm hearing you correctly there, and then take advantage of those discounts. So now the policy is owned by the ILIT, the Irrevocable Life Insurance Trust. So it's outside the taxable estate. Then what happens?
Usually in the 6th year, we'll inject one more premium into the policy. However, when we do this, we'll typically use a bank's capital to pay the additional premium. And then we'll use the remaining amount that's still in the profit sharing plan to pay the interest only payments each year to the bank, which is called premium financing. So just again, kind of recap the step-by-step process. Once the IRA funds are rolled over into the profit sharing plan, the profit sharing plan then buys a life insurance policy, pays 4 years of premium into the policy. In year 5, the ILIT buys the policy out of the profit sharing plan. And then in year 6, we inject one last premium into the policy and we finance that premium. Much more efficient to use that type of leverage.
Okay. Wow. A lot of work put into this, a lot of strategy here. And we know that you're one of the premium financiers in the country. And when it comes to extremely large life insurance policies, in fact, you've written several books on the topic, correct?
I have. As Patrice gave me that really wonderful introduction there, I have published 11 books in my career. 3 of them were specifically about premium financing. They're all on Amazon now. And in fact, the most recent one I put out was in January of this year, 2024.
Okay. And what's that one called?
It's called Premium Finance Life Insurance, the key to effective estate tax planning. And it's the 2024 edition. The version prior to this one I put out in 2021. And as you know, the landscape in my space, the premium financing space, evolves very, very quickly. So I've decided to put out a new edition of this book at the beginning of each year, kind of an updated version, so the content is always current and relevant.
Yeah, that sounds like a lot of work. And I know you published a lot of books over your career, and put a lot of work and effort into it. Also understand that you have an international distribution as well.
Yeah, I'm actually in 14 different countries now, in addition to the US. In fact, for this most recent book I put out, I got word from my distributor last week that that book is now in China, the Czech Republic, Denmark, Italy, and Poland.
Amazing. Well, congratulations.
Oh, thank you. Thank you.
When someone uses your IRA bailout plan, how much additional benefit do they really get in comparison to a traditional IRA or a Roth IRA, which is what their path is on now?
As an example, I literally just ran this case a few days ago on a married couple. I pulled it up on my screen here so I can give you some specific info.
Yeah.
Husband is 66 years old. The wife is 59. They have a $4 million IRA. And so in this case, we use the survivorship policy, which means that the insurance policy is on both the husband and the wife on one policy consolidated. And then the policy pays out at the death of the second spouse. If the husband predeceases the wife, which is usually what happens, right? Women typically live longer than us guys. And if the wife, assuming she dies at, say, age 88, and the reason we picked that is 30 years from now, their adult kids would get $21 million tax-free using the IRA bailout plan because of the life insurance policy versus only 8.2 million in a traditional IRA plan. So we're talking about a 2.5 multiple, 2.5x increase. That's quite a bit, 2.5 times more. I think that's pretty good.
That is incredible. So, I mean, more than double the outcome. That's really very substantial.
Yeah, absolutely.
So why wouldn't everyone do this?
Yeah, well, again, it depends on the client's unique situation, right? So, for example, if you have a client that thinks that they won't need any of their IRA funds to retire on, but they might need them because they don't have enough assets outside their IRA to live on, then they should not do this, right? This is really only for folks that they'll never need their IRA funds and their kids are just going to inherit the entire IRA. And when that happens, they're going to get double taxed. If they're in that situation where they're 99.99999% sure they're never going to use these funds for their own purposes, lifestyle expenses, then they should absolutely do this to avoid that double taxation.
Yeah, makes a lot of sense. So who else is the IRA bailout plan really not appropriate for?
Yeah, if the client's too old or too unhealthy, and when I say too old, typically when they reach age 80, and that's kind of the upper end of when this makes sense. Or they could be younger, but maybe they're too unhealthy, right? Age and the client's health are both contributing factors to the cost of the life insurance. So if the cost of life insurance is too high, right, it might not justify the return in terms of death benefit compared to leaving the money in the IRA or compared to rolling it over into a Roth conversion. My firm, we run the analytics for each client to make sure that the math plays out to their advantage for them specifically, right? One size definitely does not fit all. There are no absolutes in this. When we run the specific analytics for that specific client and their specific situation, we'll be able to, again, mathematically determine whether or not this makes sense for them. And if it doesn't make sense for them, I'll be the first one to say, hey, this is not for you.
Yeah, and it sounds like the numbers will tell that story, that you're going to do enough illustrations and use the variables enough to help them to understand whether the numbers work for them. As long as they look at it like, I know that I don't need this money for my retirement life. I've got all my ducks in a row there. So if I go down this path, then the analysis will prove that out mathematically, and then they would just move on from there.
Yep.
So is there anyone else that you can think of that is not suitable? Because it sounds to me like anybody who can do this and knows that they don't need the money, this might be a really good option for them.
Yeah, I mean, outside of those two issues, again, if the client is sure that they will not need these IRA funds for their own retirement, they just want to max out what goes to generation 2. And if they're under the age of 80 and reasonably healthy, it's really kind of a no-brainer.
Yeah, that makes sense to me. So, okay, now how can people find out more about this IRA bailout package?
If you go to IRABailoutPlan.com, I've got a 3-minute video, very brief, that outlines the basic concept. And then I also have a more robust 12-minute video where I take you through a case study so you can see how the moving parts work, how the whole thing is set up, and also just to see just how much we can actually increase that net amount that goes to generation 2. again, we're all about the math, right? The math either proves positive or it proves negative. If it proves negative, it's pretty obvious that the client should not do it. And if it proves positive, just the inverse, right? It's pretty much a no-brainer.
Yeah, absolutely. Well, that's a wrap. So now we just get him to the landing page or get the clients to our website or whatever the case may be, and then get them introduced to you. How's that?
Yep, absolutely.
All right. And Ken, before we go, how can people reach you?
Yeah, so Pinnacle Financial Wealth Management, 321-454-3623. And come visit our website at pinnaclefinancialwealthmgmt.com.
So, gentlemen, once again, you knocked it out of the park with your discussion of the IRA bailout plan. And listeners, remember to follow this podcast for the latest episode and so much more information, and share with others. I'm Patrice Sikora, and thanks for being with us.
Thank you for listening to the Proactive Tax Strategies podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.pinnaclefinancialwealthmanagement.com or give us a call at 321-454-3623. Securities offered through IRA Wealth Management, LLC, members FINRA and SIPC. Investment advisory services offered through IRA Wealth Advisors, LLC, an SEC registered investment advisory firm. Pinnacle Financial Wealth Management, IRA Wealth Advisors, and IRA Wealth Management are independent entities.